Welcome. Today, we're diving into the basics of the stock market. If you've ever wondered what the stock market is or how it works, you're in the right place. The stock market is a place where shares of publicly listed companies are bought and sold. It's a key part of the global economy, allowing businesses to raise money and investors to potentially grow their wealth. In this video, we'll break down the core concepts, how the market operates, and why it matters to everyday people. Let's start by understanding what a stock actually is. A stock represents ownership in a company. When you buy a stock, you're purchasing a small piece of that business, known as a share. Companies issue stocks to raise money for growth, new projects, or to pay off debt. As a shareholder, you may benefit if the company does well, often through price increases or dividends. Stocks are traded on stock exchanges, which are like marketplaces for buying and selling these ownership pieces. Next, let's see how these exchanges work. Stock exchanges are organized platforms where stocks are bought and sold. Famous examples include the New York Stock Exchange, NYSE, and the NASDAQ. These exchanges provide a regulated environment, ensuring fair and transparent trading. Buyers and sellers come together, and prices are determined by supply and demand. The exchanges also set rules to protect investors and maintain market integrity. Let's look at how a typical trade happens on an exchange. Trading stocks involves buyers and sellers placing orders through brokers. When you want to buy a stock, you place an order with your broker, who then matches it with someone willing to sell. The price is set by what buyers are willing to pay and what sellers are willing to accept. This process happens quickly, often in seconds, thanks to modern technology. Trading can be done online or through traditional brokerage firms. Let's explore the role of brokers next. Brokers act as intermediaries between you and the stock exchange. They help you buy or sell stocks and often provide research, advice, and trading platforms. In the past, brokers worked on the trading floor, but today, most trading is done electronically. Some brokers charge commissions, while others offer commission-free trades. Choosing the right broker depends on your needs, trading style, and the services you value most. Now, let's discuss why companies list their stocks on exchanges. When a company goes public, it means they're offering shares to the public for the first time through an initial public offering IPO. This helps them raise large amounts of money to fund expansion, research, or pay off debts. Going public also increases a company's visibility and can attract more investors. However, it comes with responsibilities, like regular financial reporting and meeting regulatory requirements. Next, let's see what happens after a company is listed. Once a company is listed on a stock exchange, its shares can be traded freely among investors. The company receives the money from the IPO, but after that, trading happens between investors. The company's stock price can fluctuate based on business, performance, news, and overall market conditions. Investors can buy or sell shares at any time during market hours. Let's look at what drives these price changes. Stock prices are influenced by many factors. Company performance, earnings reports, industry trends, and economic news all play a role. If investors believe a company will grow, demand for its stock rises, pushing the price up. Bad news or poor performance can cause prices to fall. Broader market trends, like interest rates or political events, also impact prices. Understanding these factors helps investors make informed decisions. Next, let's talk about the main types of stocks. There are two main types of stocks: common and preferred. Common stocks give shareholders voting rights and the potential for dividends, but their value can rise or fall. Preferred stocks usually don't have voting rights, but they offer fixed dividends and have priority over common stocks if the company pays out assets. Each type has its own risks and rewards. Let's see how investors can make money from stock. Investors can make money in the stock market in two main ways: capital gains and dividends. Capital gains happen when you sell a stock for more than you paid. Dividends are payments some companies make to shareholders, usually from profits. Not all stocks pay dividends, but many established companies do. Both methods can help investors grow their wealth over time. Now, let's discuss the risks involved in stock investing. While the stock market offers opportunities, it also comes with risks. Stock prices can be volatile, meaning they can rise or fall quickly. There's always a chance of losing money, especially in the short term. Factors like company performance, economic downturns, or global events can impact your investments. That's why it's important to research and diversify your portfolio. Let's see how diversification can help manage risk. Diversification means spreading your investments across different stocks, industries, or even asset classes. This way, if one investment performs poorly, others may do better and help balance your overall returns. Diversification is a key strategy for reducing risk in your portfolio. It's like not putting all your eggs in one basket. Next, let's look at the major stock market indexes. A stock market index tracks the performance of a group of stocks. Examples include the S&P 500, Dow Jones Industrial Average, and NASDAQ Composite. These indexes give investors a snapshot of how the market or a sector is performing. They're used as benchmarks to compare individual investments or portfolios. Understanding indexes helps you gauge market trends and make informed decisions. Now, let's see who participates in the stock market. The stock market includes a wide range of participants: individual investors, institutional investors like pension funds and mutual funds, and even governments all buy and sell stocks. Each group has different goals and strategies. Some invest for long-term growth, while others trade frequently for short-term gains. The diversity of participants helps keep the market active and liquid. Let's explore the concept of liquidity next. Liquidity refers to how easily you can buy or sell a stock without affecting its price. Highly liquid stocks have lots of buyers and sellers, making trades quick and prices stable. Less liquid stocks may be harder to trade and can have bigger price swings. Liquidity is important because it affects how easily you can enter or exit investments. Next, let's talk about the role of regulators in the stock market. Regulators oversee the stock market to ensure fairness, transparency, and investor protection. In the U.S., the Securities and Exchange Commission, SEC, is the main regulator. They set rules for companies, brokers, and exchanges, and investigate fraud or insider trading. Regulations help maintain trust in the market and protect investors from unfair practices. Now, let's look at how technology has changed the stock market. Technology has revolutionized the stock market. Today, most trades happen electronically, often in milliseconds. Online trading platforms make it easy for anyone to buy or sell stocks from their computer or smartphone. Algorithms and high-frequency trading have increased market efficiency, but also added complexity. Technology has made investing more accessible, but it's important to understand the risks and tools available. Let's discuss the concept of bull and bear markets. A bull market is when stock prices are rising and investors are optimistic. It's often associated with economic growth and strong company performance. A bear market is the opposite. Prices are falling and investors are pessimistic. Bear markets can be triggered by economic downturns or major events. Understanding these cycles helps investors manage expectations and make better decisions. Next, let's look at the importance of research before investing. Before investing in stocks, it's crucial to do your homework. Researching a company's financial health, industry trends, and management team can help you make informed choices. Look at earnings reports, news, and analyst opinions. The more you know, the better your chances of making smart investments. Let's talk about some common investment strategies next. There are many ways to invest in the stock market. Some people buy and hold stocks for the long term, hoping they'll grow in value. Others trade frequently, trying to profit from short-term price movements. Strategies like value investing, growth investing, and dividend investing each have their own approach. It's important to choose a strategy that fits your goals and risk tolerance. Next, let's discuss the concept of market orders and limit order. When buying or selling stocks, you can place different types of orders. A market order buys or sells immediately at the best available price. A limit order lets you set the price you're willing to pay or accept. If the market reaches your price, the trade happens. Each order type has its pros and cons, depending on your priorities. Understanding these options helps you trade more effectively. Let's look at the concept of dividends in more detail. Dividends are payments made by companies to their shareholders, usually from profits. Not all companies pay dividends, but many established firms do. Dividends can provide a steady income stream, especially for long-term investors. The amount and frequency of dividends can vary. Some investors focus on dividend-paying stocks for stability and income. Next, let's discuss how taxes affect stock market investing. Profits from selling stocks, known as capital gains, are usually subject to taxes. Dividends may also be taxed, depending on your country's rules. Tax rates can vary based on how long you hold the stock and your income level. Understanding tax implications helps you plan your investments and avoid surprises. Let's look at how emotions can impact investing decisions. Investing can be emotional. Fear and greed often drive market movements. When prices fall, some investors panic and sell, while others see opportunities to buy. Staying calm and sticking to your strategy is important for long-term success. Emotional decisions can lead to mistakes, so it's wise to have a plan and follow it. Next, let's talk about the importance of patience in the stock market. Successful investing often requires patience. Markets can be unpredictable in the short term, but over time, they tend to grow. By staying invested and not reacting to every market swing, you can benefit from long-term growth. Patience helps you avoid costly mistakes and take advantage of compounding returns. Next, let's discuss the role of news and media in the stock market. News and media have a big impact on stock prices. Earnings reports, economic data, and global events can cause prices to rise or fall quickly. Sometimes, rumors or speculation can move the market even before facts are known. It's important to verify information and not react impulsively to headlines. Let's look at how global events can influence the stock market. The stock market is influenced by events around the world. Political changes, natural disasters, and international conflicts can all affect investor confidence and stock prices. Globalization means that markets are more connected than ever, so events in one country can impact markets elsewhere. Being aware of global trends helps you understand market movements. Next, let's discuss the concept of market capitalization. Market capitalization, or market cap, is the total value of a company's outstanding shares. It's calculated by multiplying the stock price by the number of shares. Companies are often categorized as large cap, mid cap, or small cap based on their market cap. This helps investors compare companies and assess risk. Larger companies tend to be more stable, while smaller ones may offer higher growth potential. Let's look at the concept of blue chip stocks. Blue chip stocks are shares of large, well-established companies with a history of reliable performance. These companies are leaders in their industries and often pay regular dividends. Blue chip stocks are considered safer investments, especially for beginners or those seeking stability. However, they may offer slower growth compared to smaller, riskier companies. Next, let's discuss the concept of stock splits. A stock split happens when a company increases the number of its shares by dividing existing shares. For example, in a 2-for-1 split, each shareholder gets 2 shares for every one they own, but the total value stays the same. Splits make shares more affordable and can attract more investors. They don't change the company's value, just the number of shares and price per share. Let's look at reverse splits next. A reverse stock split is the opposite of a stock split. Here, a company reduces the number of shares, increasing the price per share. For example, in a 1-for-2 reverse split, every 2 shares become 1, but the total value remains the same. Companies may do this to meet exchange listing requirements or improve their stock's image. Reverse splits don't affect the company's value, just the share structure. Next, let's discuss the concept of market volatility. Volatility refers to how much stock prices move up or down over time. High volatility means prices change rapidly, while low volatility means they're more stable. Volatility can create opportunities for traders, but also increases risk. It's influenced by news, economic data, and investor sentiment. Understanding volatility helps you manage risk and set realistic expectations. Next, let's look at the concept of market hours. Stock markets have set hours when trading is allowed. In the US, the main exchanges are open from 9:30 a.m. to 4 p.m. Eastern Time, Monday through Friday. Some platforms offer pre-market and after-hours trading, but these sessions can be less liquid and more volatile. Knowing market hours helps you plan your trades and avoid surprises. Next, let's discuss the concept of short selling. Short selling is a strategy where investors bet that a stock's price will fall. They borrow shares and sell them, hoping to buy them back later at a lower price. If the price drops, they profit from the difference. Short selling is risky because losses can be unlimited if the price rises instead. It's a complex strategy best suited for experienced investors. Next, let's look at the concept of margin trading. Margin trading lets investors borrow money from their broker to buy more stocks than they could with their own cash. This can amplify gains if prices rise, but also increases losses if prices fall. Brokers require investors to maintain a minimum balance, called a margin requirement. If your account falls below this, you may face a margin call and have to deposit more money or sell assets. Margin trading is risky and not for everyone. Next, let's discuss the concept of ETFs. ETFs, or exchange-traded funds, are investment funds that trade on stock exchanges like individual stocks. They typically track an index, sector, or commodity, offering instant diversification. ETFs are popular because they're easy to buy and sell, often have low fees, and let investors access a wide range of assets. They're a great way for beginners to diversify without picking individual stocks. Next, let's look at mutual funds. Mutual funds pool money from many investors to buy a diversified portfolio of stocks, bonds, or other assets. They're managed by professional fund managers who make investment decisions on behalf of investors. Mutual funds are a convenient way to diversify, but they may have higher fees than ETFs. They're bought and sold at the end of the trading day at the fund's net asset value. Next, let's discuss the concept of dividends reinvestment. Dividend reinvestment means using dividends you receive to buy more shares of the same stock or fund. Many companies and funds offer automatic dividend reinvestment plans, DRIPs. This strategy helps your investment grow faster through compounding as you earn returns on both your original investment and the reinvested dividends. It's a simple way to build wealth over time. Next, let's look at the concept of dollar cost averaging. Dollar cost averaging is an investment strategy where you invest a fixed amount of money at regular intervals, regardless of the stock price. This approach helps reduce the impact of market volatility as you buy more shares when prices are low and fewer when prices are high. Over time, it can lower your average cost per share. Dollar cost averaging is a disciplined way to invest and can help manage risk. Next, let's discuss the importance of setting goals. Before investing, it's important to set clear goals. Are you saving for retirement, a house, or your child's education? Your goals will influence your investment choices, risk tolerance, and time horizon. Setting goals helps you stay focused and measure your progress. It also guides your strategy and keeps you motivated during market ups and downs. Next, let's look at the importance of reviewing your portfolio. Regularly reviewing your investment portfolio is essential. Over time, your needs and market conditions may change. Rebalancing helps keep your investments aligned with your goals and risk tolerance. It's a good idea to check your portfolio at least once a year, or after major life events. Adjusting your investments ensures you stay on track and make the most of opportunities. Next, let's discuss the concept of compounding returns. Compounding means earning returns on both your original investment and the returns you've already earned. Over time, this can lead to exponential growth. The earlier you start investing, the more you can benefit from compounding. Even small, regular investments can grow significantly over years or decades. Compounding is a powerful reason to start investing as soon as possible. Next, let's look at the importance of financial education. Learning about the stock market and investing is an ongoing process. Financial education helps you make better decisions, avoid common mistakes, and reach your goals faster. There are many resources available, from books and courses to online videos and articles. The more you learn, the more confident and successful you'll become as an investor. Next, let's summarize what we've covered. We've covered the basics of the stock market, what it is, how it works, and why it matters. We discussed stocks, exchanges, trading, risks, strategies, and the importance of research and education. Remember, investing is a journey that requires patience, discipline, and continuous learning. By understanding the fundamentals, you can make smarter decisions and work towards your financial goals. Let's wrap up with some final thoughts. The stock market can seem complex at first, but with the right knowledge and approach, anyone can participate. Start by learning the basics, set clear goals, and invest consistently. Remember to diversify, manage risk, and stay patient. Over time, the stock market can be a powerful tool for building wealth and achieving your financial dreams. Thanks for watching, and best of luck on your investing journey.